Ladies and gentlemen, good day and welcome to Utkarsh Small Finance Bank Q4 FY24 earnings conference call hosted by ICICI Securities. As a reminder, all participants' line will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Renish from ICICI Securities. Thank you and over to you, sir.
Thank you, Manuja. Hi, good afternoon, everyone, and welcome to Utkarsh Small Finance Bank Q4 FY24 earnings call. On behalf of ICICI Securities, I would like to thank Utkarsh management team for giving us the opportunity to host this call. Today we have with us the entire top management team of Utkarsh, represented by Mr. Govind Singh, Managing Director and CEO, Mr. Sarju Kumar, CFO, Mr. Alok Pathak, CRO, Mr. Trilok Nath, Head Microbanking, Mr. Umesh Arora, Head Assets, Retail and Wholesale Lending, Mr. Sanjay Sharda, Head Consumer Banking, and Mr. Puneet Maheshwari, Head Finance. I will now hand over the call to Mr. Govind for his opening remarks, and then we'll open the floor for Q&A. Over to you, sir.
Thank you. Thank you, Renish. Good evening to all. Thank you everyone for taking out time to attend our Q4 FY24 earnings call. Quarter 4 has been a strong quarter for us with good business growth, healthy trend in asset quality and strong profitability matrices. Overall, FY24 has also been good business growth and profitability. This shows continuous strengthening of franchise and adequate growth opportunity for our business. Our loan book has grown by around 31% during FY24, in line with our expectation of 30% growth. This is despite relatively slower growth in H1 FY24 on account of technological changes introduced in microbanking business in beginning of FY24 and relatively lower pipeline for subsequent cycle loans in quarter 1 FY24 as it was discussed in quarter 1 and quarter 2 earnings calls. In the microbanking lending, we continue to witness healthy new customer acquisition. Subsequent cycle disbursement have also been good. New technological initiatives, that is eKYC and eSign, have stabilized. Our microbanking loan portfolio has grown by around 23% during FY24, largely in line with our expectation. We continue to believe that digital experience, which we have brought in the form of complete digital onboarding for loan as well as savings account, eSign, eKYC, digital collections through customer-specific QR code, micro ATM, video PD, and other offerings will backbone for us to build a strong and sustainable franchise with cost efficiency. Our individual loan product, MBIL, to existing mature JLG clients continues to see good traction with year-on-year growth of almost 100% with good asset quality. We see significant growth potential towards MBIL lending considering large base of our existing and matured JLG clients. We have seen healthy trend in collection efficiency and asset quality for microbanking loan portfolio. Collection efficiency improved to 97.6% for quarter 4 FY24, marginally better than our guidance of 97 to 97.5% for quarter 4 FY24. And as a result, NPAs and credit costs both declined during the quarter. We saw collections coming back to normalcy as we came out of higher number of holidays period in quarter 3 FY24 and strengthen collection focus. From the current quarter, we are planning to introduce differential rate of interest for our JLG customers. It is asset quality, vintage cost, etc., which will help us in implement risk-based pricing in microbanking lending more effectively. We have seen steady growth across our secured retail lending portfolio, MSME, housing, and CCV. We have disbursed close to 100 crore across these three products in quarter 4 FY24, almost 50% higher than quarter 3 FY24 disbursement for the three products put together. On asset quality of retail loan book, we have strengthened our collections team by adding more manpower as well as separate team for bucket-wise and vertical-wise collection. We have also implemented EBITS collection application for better tracking of our collection efforts. These are yielding good results. Furthermore, wholesale lending book remains tightly controlled. We had nil NPAs in wholesale lending. Our overall gross NPAs declined by 50 basis points during quarter 4 FY24 to 2.51% from 3.04% as on December 23. on gross advances, including IBPC book. Gross NPAs was 2.3% as on March 24. Overall credit cost declined to almost 1.7% for Q4 FY24, well within our guided range of around 2%. Overall credit cost for full FY24 at 2.2% was little higher than our guided range of around 2%. But we are confident that we will be able to reduce credit cost to our original guided range of around 2% in FY25. Nevertheless, credit cost for FY24 included additional floating provision of around 56 crore. Excluding this credit cost was around 1.8% for FY24. We will continue to build floating provision further in FY25 to strengthen our ability to withstand any unforeseen event impact better. On the liability side, our deposit growth is led by retail term deposits as we continue to focus on strengthening the deposits profile through broad basing of depositors. Our retail term deposits grew by 42.9% year on year, while bulk term deposits grew by only 12.3% year on year. We experienced relatively tighter environment for CASA deposits growth and CASA percentage on account of elevated interest rate environment, which kept depositors' preference towards term deposits. Our CASA ratio was 20.5% as on March 31, 2024. We will work to strengthen our CASA deposit growth and CASA percentage significantly over FY25. We have been able to diversify our funding profile through tapping lower cost IBPC borrowings as well as refinance borrowings at competitive rates. We are maintaining comfortable liquidity position with surplus liquidity of around 2,500 crore at the end of March 24 and LCR ratio of 166%. Our CD ratio declined to 93.7% as on March 31, 2024, and we net off refinance borrowings from advances. CD ratio declines to 84.3%. We don't have any short-term borrowings on our balance sheet. While on overall basis, liquidity and interest rate environment remains tight, we expect deposit growth to be tad higher than loan book growth for FY25, which would also help us moderating CD ratio further in FY25. We continue to build our banking franchise and opened 8 new branches in Q4 FY24 and 58 branches during FY24, taking total branch network to 888 branches. We also implemented new lead management system LEMS, which will help us in cross-sell as well as improve new sourcing across products. We are also undertaking a technology and business transformation project to strengthen our technology architecture to make it future growth ready. We believe there are significant growth opportunity available in our core geographies given the good growth potential and relatively lower financial penetration. We'll continue to strengthen our franchise and presence and explore significant growth potential through our relevant and suitable product offerings. We have been constructive about passing on increase in cost of funds, and as a result, we maintain our net interest margin which improved to 9.9% in Q4 FY24. Furthermore, we have reduced credit costs, including floating provision, to 1.7%, well within our guidance of 2%. Overall, we had healthy financial performance as reflected in our highest ever annual operating profit pre-provisions of 997 crore and PAT of 498 crore for FY24. Our ROA and ROE was 2.4% and 19.5% respectively during FY24. We will continue to build our own strategies of creating stronger franchise for our microbanking business as well as for MSME lending, housing loans and wheels lending, and more granular liability franchise. We will continue to build floating provision further in FY25 to strengthen our ability to withstand any unforeseen event impact better. We will strengthen our positioning, franchise and product further in FY25 and years to come to build stronger banking platform. Our guidance for some key numbers for FY25 are as follows. We expect a gross loan book growth of around 30%, deposit growth to be higher by at least 3 to 5%, with loan growth. With a target to reduce CD ratio further in FY25. Focus on maintaining strong asset quality with nil net NPAs and credit cost at around 2%. Credit cost guidance is including additional floating provision which bank will build in FY25. On profitability, return on assets of more than 2% and return on equity of more than 18%, and cost income ratio in the range of 54 to 57%. Now I'll hand over call to Sarju, our CFO, for taking you through financial performance for the quarter.
Thank you, Govindji, and good evening, friends. Actually, this earnings call is the first call where we are going to talk about the full year performance. And of course, we have been speaking with you even prior to IPO during the road shows, telling about company story and trajectory of growth. And we also spoke with you during the September and December quarter results. Let me reflect, on the year and recollect the conversation that we have had. The bank's yield loan advances has been 19% through and through, in spite of the mix having changed. We ended Q4 with a yield loan advances of 19.46%, and for the full year, our yield continued to remain at 19%. On NIM, with the reason of our good business model, we have seen that our NIM has been upward 9%. We ended NIM of 9.86% for Q4, and for the full financial year, our NIM was 9.44%. We have been talking about our cost-income ratio to be in the range of 54 to 57%. We ended Q4 with our cost-to-income ratio at 57%, and for the full year, our cost-to-income ratio was 56.38%, and our ROA has been upward 2%, and this conversation, as I said, we have been having through and through for last 6 to 8 quarters before IPO and during the subsequent IPO calls that we have had, has been Q4 ended at 2.91%, and for the full year, our ROA is 2.45%. ROE has been, said that to be 18% with a high-raised, larger capital through which we raised through IPO. Our Q4 ROE has been 22.26%, and for the full year, our ROE has been 19.54%. Now, let me quickly go to the results per se and put numbers to what Govindji just spoke about. For the March 31st financial ended, we have reported a gross loan portfolio of 18,299 crores against 16,407 crores on the immediate previous quarter, which is a quarter-on-quarter range of 11.5%. And if I were to compare with gross loan portfolio previous year end at 13,957, our gross loan portfolio, which is at 18,299 crore, is registering a growth of 31%. The total deposit we clocked at year end was 17,473 crores against 15,111 crores, a quarter-on-quarter rise of 15.6%, and on a year-on-year basis, we were at 13,710 crore. Today at 17,473 crore deposit, we have registered a YOY growth of 27.4%. Largely, the composition of deposit has been growth in retail term deposit exceeding 42% year-on-year from 23 March to 24 March. Now coming to the P&L, we have registered and rise in interest income. Our interest income for the quarter was 540 crores against previous year corresponding quarter, a rise of 32%, and on year-on-year basis, the net interest income was 1,886 crores against 1,529 crores, a YOY rise of net interest income by 23%. Our total operating income was 661 crores for the current quarter compared to previous year corresponding quarter FY2023 at 479 crores. Operating income has gone up by 38% quarter on quarter, and if I take the full year operating profit, we have done an operating profit of 2,286 crores against 1,828 crores, a growth in operating income by 25%. If you look at our operating profit, we had 282 crores for the current quarter and 208 crores immediately previous year quarter, Q4 FY23, registering a growth of operating profit by 35%. And for the full year, our operating profit is at 997 crores against 838 crores for the previous full financial year, and 19% growth in operating profit. In fact, both operating profit, and I'm just going to talk about that, has been highest in couple of years of history of Utkarsh. Our PAT for the quarter was 160 crore against 134 crores immediately previous quarter, a rise of 19%. And for the full year, we ended a reported PAT of 498 crores against 405 crores, a growth of 23% YOY. Just a few more, matter to say, like we continue to create floating provision, and the number of floating provision that has gone into the financial year 23-24 is 56 crore, which was at 1.5% of my JLG book. We intend to continue this provision and inch it up to 2% this year on the closing portfolio of JLG book. I think this obviously is with the expectation to strengthen the balance sheet and make provision for any unforeseen circumstances. And we have spoken before that this floating provision is a straight line accrual in accounts month on month and quarter on quarter, and this floating provision is used only in eventuality of some unforeseen circumstances. And that provision we generally would want to make at times when profits are available and the business model is giving good returns. So we continue to work on making floating provision on a prudency basis. I think credit cost, Govinji mentioned, at 1.75% in Q4 with collection and efficiency and better collection from write-offs. Credit cost is at 2.2, but the trending at the Q4 beginning at 1.7, we are hoping to keep that around 2%. The asset side, quality side, gross NPA is 2.51 against 3.23. It has improved, and my net NPA is almost 0.03%, inching to the 3-digit zero figure very soon, against 0.39%. I think I want to say that this year's strong financial performance for the quarter and for the full year is largely in line with our expectations. We look forward to answer your questions and queries and speak about it. While I just spoke about year-on-year, I think Govinji has already spoken about the wider windshield and opportunities that we have, and he's already given the guidance on some of the KPIs. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah, hi, good evening. Congratulations on very strong performance. So I have 2 questions. Firstly, on the strong growth in disbursements of micro banking JLG, can you split this growth between volume and ticket size, and what was the average disbursement ticket size in Q4?
Okay, I think I'll just pass on to Trilok, but I want to make one mention that our ticket size has not gone up in Q4. In fact, it has not gone up at all in the entire year also. So the entire growth is on account of more number of new customers and disbursement to subsequent customers. But Trilok can speak a little more about this part.
So our ticket size has not gone up as Andy said, but new client acquisition, it was almost 50% in S2, 50% of our entire disbursement. So basically we produce a growth on that side, and then we have the subsequent cycle disbursement in geographies like Odisha, Rajasthan, Jharkhand, and of course in UP and Bihar. So we have not disbursed, for last 2 years we have problem due to COVID, so we have not disbursed too many clients. neither on subsequent cycle or on fresh center or fresh client. So basically, this growth came from the subsequent cycle disbursement and this new client acquisition. Also, we added clients at the existing centers. It's not only opening up the new centers, going to the new villages or new basti mohalla, but also adding clients at the existing center. So that has driven the growth basically.
And so that means, has there been any change in customer retention rates in the main markets of Bihar and UP, which can maybe due to increase in competition or leverage of the borrower, or it remains the same?
So there are two aspects you mentioned. That one is that we have got more and more new customers now. Post-COVID, that growth was slow in terms of adding new customers. That is one part. And second, we had told in the previous earning calls also, we had some challenge because of the COVID. You can see the next one and a half years time, we had very limited number of subsequent customers because we are not adding customers 22 and 23. So in the H1, we had very limited number of subsequent cycle customers. So in the H2, you can say both have happened better. We could acquire more and more new customers, as well as our subsequent cycle, the base number of customers was much higher for this period. I think maybe Puneet they have the exact number also.
Yeah, Ravi. So if you just look at the JLG growth, which is about 20% for full financial year, our average ticket size between March 23 to March 24 has gone up by about 4%, and balance 16% growth has come on account of new customer acquisition. And dropout has been largely same between quarter 2, quarter 3, quarter 4. So there is no material change in the dropout ratio.
And this, significant improvement in collection efficiency in micro banking, 98 versus 96. So one is, last quarter with this factor of more holiday. But can we, so from a sustainability perspective, can the current collection efficiency of 98% and thereabout sustain in the coming quarters as well?
So we have tried to create a structure around collections because in Q3 we have too many slippages due to holidays, as you said. Then we have tried to create a structure around collections, and we tried to follow up from head office level, from the zonal offices and regional offices, the collection in each bucket. So this slippage was there, but sometimes when collection is not there, sometimes we follow only 90 DPD or 88, 89 DPD. So instead of that, we kept following on each bucket. So 1 to 30, 31 to 60, 61 to 90. So that helped us a lot. Again, we have driven this collections of written accounts. So there also we have good success. In quarter 4 especially. So all these efforts put together, this improved the collection efficiency, and we hope that it will continue because now structure is in place, so it will definitely continue what we experience in this quarter 4.
Got it. Just one last question on on the deposit side. What is the current cost of retail term deposits? And what is the incremental cost? And what is the maturity profile?
Okay, so cost we have given on the presentation as well. So from a term deposit perspective, the average cost is about 8.5, 8.6% for us. And if you see highest rate, what we are offering is 8.5% for a regular customer and 9.1% for senior citizen. So that's how we are placed. Tenor, I'll just tell you one second. So in terms of tenors also, we are seeing incrementally more longer tenor deposits coming in. So now in terms of breakup, if I just tell you, so right now, deposits which are 2 years plus are about 12-13% of our total deposits, which earlier actually was much lower percentage. So you see, it also a function of the rate of interest, in terms of which bucket has the highest rate of interest. Now if you see, the highest rate is between 2 to 3 year bucket, and that is the bucket we are seeing a sizable deposit acquisition.
Yeah. Thank you so much and best of luck.
Thank you. Yeah.
Thank you very much. The next question is from the line of Pritesh Bam from DAM Capital. Please go ahead.
Hi, good evening, sir. Sir, two questions. One is if you have mentioned anything about margins, they have been a little bit higher. Is there any interest reversal or interest booking because of recovery and all? Can you quantify if there is any?
So, it's not much. Only impact from our net interest margin perspective is the lower fresh slippages versus what was the case, let's say, in quarter 3. So, in quarter 3, we had fresh slippages of 135 crores, and this quarter we had less than 100 crores. So, that is the only additional impact from an NPA perspective. Otherwise, the net interest margin is also positively impacted by the repricing of the microfinance loan book, which we had highlighted last time. So, that is also, in a way, supporting net interest margin.
So can you give how much is the disbursement yield, the outstanding yield on the microfinance book as well?
So microfinance disbursement yield is 25% and our portfolio basis yield is 24% now for the quarter 4.
And how much would have that changed in last 6 months?
Just 1 second. So in quarter 3, we were close to 23.5. In quarter 2, we were at 23%, and before that, in quarter 1, we were at 22.7%. So it has been increasing by 30 to 50 basis points quarter on quarter. One, obviously, is the benefit of, this quarter is both benefit. One is lower EPAs and the fact that repricing is also happening.
Got it. Second question was on OPEX. Looks like a little bunching up in this quarter. What is the trend going to be going ahead, and anything to look into this quarter? And what will be our cost to income thought process basically?
So cost to income going ahead, initially also talked about. So cost to income we think would remain in a range of 54 to 57% for us. On an incremental basis. And quarter on quarter, at times expenses are also, let's say, basis the activity level. So as business activity or some other ground level activity picks up, quarter on quarter expenses may be a little higher in certain quarters depending on the activity level. And that is what we have seen in this quarter. And overall basis, we expect cost income ratio to be in a range of 54-57%.
Great. Congrats on the great numbers. Thank you.
Thank you.
Thank you very much. The next question is from the line of Aman Gupta from Occult Capital Growth Fund. Please go ahead.
Yes. So my question was on the merger, and what is the timeline we are expecting?
So if you remember that we had discussed earlier also in the previous call, and now we have got a formal approval from both the boards that we should go ahead with the process. And we have initiated the process, getting the people, when I say consultants and those who will help us in the whole process. And so that process has already commenced. It's very difficult to pinpoint the overall time taken, but we have seen in other cases also takes around 12 to 15 months time, and we expect it should be in terms of timeline should be in the similar range. Maybe around 12 to 15 months from now, we should be able to complete the whole process.
And also, what could we expect about the reverse ratio? Because I'm asking, will it be given at a discounted rate or a premium rate?
No, it's too early to talk about that. We have not discussed also. So maybe as and when if this discussion happens and it is closed, I will certainly come back to you. But it is not yet discussed also, as of now.
Okay. Thank you very much.
Thank you.
Thank you very much. The next question is from the line of Ashlesh Sonje from Kotak Securities. Please go ahead.
Hi team, good evening. Congratulations on the strong numbers for the quarter. I have a few questions. Firstly, on the recovery income from return of assets, that was very strong this quarter. What is the outlook for that going forward, given that we also written off quite some 90 odd crores in the fourth quarter?
So our assessment is that, obviously we have seen very strong in case of quarter 4, but on a regular basis when you look at, we expect that, maybe around 6-7 crore on an average on a monthly basis. That is the trajectory we are expecting this year. So overall, maybe in the range of say 65 to 80 crore is what we expect overall write-off collections will happen. Again, as I mentioned, it's indicative or guidance from our side. That is what we expect.
Okay. And secondly, on the cost of funds side, that has gone up by only 10 odd basis points for the quarter. What is the outlook on that? Would you say that the repricing on the deposits is largely complete now?
So as far as repricing is concerned, it's almost complete, maybe around 10-12% of deposits where the repricing is yet to happen. So from now, as you may, we can say from system angles, the rates are not going up. Obviously, there are, you can say liquidity crunch, and you must have seen we have very strong liquidity base right now, almost 2,500 crore at the end of March. So our perspective, maybe, it can go up at the most, maybe 10 to 15 basis points, not more than that. And during this financial year, if market is, remains the same level where it is today, it might go up by around 10 to 15 basis points, not beyond that.
Okay. Sir, on the OpEx front, it has been a bit higher in this quarter, both on the staff side as well as non-staff side. What is leading to it? Is it also related to the higher amount of focus that we have on collections starting this quarter?
No, on a salary, we can say it is both, largely a variable cost component, which has driven, which is both, you drive, let's say, some collection efforts, and it is also a little bit, it's a variable component largely. And on other operating expenses, as I said, if you see last 3 quarters, between quarter 2 to quarter 3, our OpEx is largely the same. This is also dependent on the activity level. So some of the expenses like say, repair and maintenance, printing, postage and courier, etc., were a little higher in this quarter. Some bit of the legal and professional expenses, etc., were a little higher in this quarter. So essentially, let's say from a quarterly trend perspective, what we can say is it is largely depending on, let's say, the activity level, both the business level activity as well as the ground level activity at times. And from an overall outlook perspective, we can say from a OpEx cost metric perspective, whether it is OpEx by ATA or cost to income ratio, we will be largely in a range in financial year 25, where we have been in financial year 24.
Understood. Thanks. Just one last data keeping question. Can you give a breakup of the slippages for the quarter across segments? And specifically for the microfinance segment, can you give me the slippage for the past few quarters?
Yeah. So for this quarter, we had a total fresh NPA generation of 93 crore, of which microbanking is 65 crore, MSME is 11 crore, CBNC is 12 crore, housing is 4 crore, and others are 2 crore. And for last few quarters, microbanking in quarter 3 was 98. Before that it was 75, and before that it was 71 crore in quarter 1.
Okay, perfect. Thanks a lot.
Yeah, thank you.
Thank you very much. The next question is from the line of Renish from ICICI Securities. Please go ahead.
Hi, sir. Just 2 questions from my side on the non-MFI book. So when we look at the MSME lending book, there has been a sharp jump in the disbursement during Q4. So when we look at last 4 quarters, the disbursement has been range bound around 300 to 350 odd crore, but that has suddenly gone up to some 550 odd crore in Q4. So what is leading to that? It is just because we might be expanding our distribution network, or is there something else to read into it?
So it's a combination of few factors. One is you mentioned, expanding the distribution network, because wherever we have general banking branches, sometimes even the micro banking branches, we expand our MSME, housing and wheels network. So that is one part for sure. Second, I think during last few years, we have been able to have a stable team also, because it normally takes around 2 to 3 years time to reach that level. So at least in MSME, we can say that we have a stable team now. And the trajectory what we have seen in the last year, that will continue next year also. That is for sure, from the MSME. Not only in MSME, but even the other products also, MSME or wheels and and housing and retail LAP also. So the trajectory will continue. One factor certainly happens that quarter four. I think there is a greater activity level that goes up. So around 10 to 15% increase because of that also happens for sure. But overall trajectory for next year will remain in the same range. I'm talking growth trajectory will remain in the same range what we have seen in FY24.
Got it. And sir, related question to this on the yield side as well. So when we look at a year back in Q4 last year, our yield was some 11%, which went up to almost 11.8 in Q3, and which sort of moderated by 40 basis points in Q4. So this is let's say a general interest rate movement, or let's say we have changed our target segment from a high ticket to low ticket, or anything like that. I mean, is there something to read into the disbursement yield movement?
Yeah, certainly. I think when you talk of disbursement yield movement, we are focusing more and more on the, you can say, lower end of MSME. Our focus area is, I mean, I'm not saying we don't do transactions of crore plus, but it is more focused on the 25 to 50 lakh type of bracket, where we can do a lot of work in our some of our core geographies, as well as the yields are better. I mean, we might have done some more transactions, and the competition also it gets intensified in quarter four. That's why a little lower yield in quarter four. But whatever we just saw trajectory of yield till quarter three, maybe around 30 to 40 basis point higher yield for FY25. That is what we can guidance today.
Got it. And again, secondly, on the housing loan side, so when we look at the average ticket size at around 20-25, suddenly not the segment where most of the affordable housing finance guys are operating. Those guys are at around a million odd. So here, who are our competition in this segment? I mean, do we compete with the banks, and hence the rates are at, let's say, 10.5 versus 13-14% for the peer NBFCs? I mean, how one should look at this segment? What is the strategy?
Hi. Yeah. So as you rightly said, our ticket size is ranging between 20 to 25 lakh rupees. Here our competitors is our peer banks, other small finance banks, and some big NBFCs. So here we want to see that the quality of the portfolio, and at the same time we are able to garner 1.5% higher rate of interest from the universal bank. So we, as you know, that our presence is into tier 2 and tier 3, and specifically in UP and Bihar, and we want to leverage that our footprint in those locations, and thus we are able to garner higher rate of interest.
Renish, I want to add one thing on this part. So the moment you go from 25-30 lakh to say 10 to 15 lakh, I think the team is is not aligned to that. That is our experience. The same guy doesn't do that part. No, you can say to take care of that part, what we are doing, I think we mentioned in our last earnings call also, micro life is one product which we intend to focus upon. We have already got a team, and obviously we expect some good traction during this year. It takes a little time to complete make the team and generate volumes from there. So that is one part, and we will also be considering rural housing type of things. But for that we require a separate team. So there the yields will also be better, and ticket size will certainly maybe in the range of 7 to 12 lakh type of thing. So for that we need to create a separate, and especially in our core geography, Uttar Pradesh, Bihar, Jharkhand, in that area, the opportunity is quite high. So our idea is that FY25 should see some good traction in this, and maybe some better yields also because of that.
Got it. No, so just wanted to understand that in housing loan segment, we will continue to operate in this 20 to 25 lakh rupees ticket size, or we intend to get into the rural housing loan wherein ticket size will be 7 lakhs. I mean, what's the strategy in FY25?
So in short term, we will continue with this segment as well as build our micro lab and rural housing both. And maybe after down the line, year 1.5 year down the line, we can review that whether we what makes sense in long term for us or not. Today we intend to certainly build this portfolio as well as create 2 new segments where the yields will be much higher, but the segments are different and the teams are also getting created separately for that purpose.
So we have already started investing to build a rural housing?
We have already started for micro lab for sure. We have around 50 odd people team is already in field and they have started getting trained and product has been launched and some sourcing has already started in the beginning. So that has already been done. And rural housing will see next 2 to 3 months time. That will also get launched in by end of quarter 1 or maybe beginning of quarter 2.
Got it. And just a last clarification. So when it comes to the non-MFI book, it is fair to assume that broadly we'll start with our core geographies, which is UP and BR, and then maybe after stabilizing process, a bit of handle on asset quality, etc., then we'll type the other geography?
Yeah. Yes. That remains the thought process always. And in this case also, we'll start with our core geography only.
Okay. That's it from my side. Best of luck, sir.
Thanks, Dennis. Thanks a lot.
Thank you very much. Next question is from the line of Shailesh Kanani from Centrum Broking. Please go ahead.
Yeah, thanks for the opportunity. So a couple of questions from my side. Sir, can you give some color on in terms of AUM breakup for the next year, where you said that 30% growth will be envisaged? How would that mix look like, and what does the management think of corporate loan or 10 or 11% wholesale funding what we do? So what is our view on that?
So maybe I'll ask Puneet to give the breakup for next year. But broadly speaking, our thought process is we have done corporate lending, but the corporate lending are not the way universal bank does. Our ticket size will be 10 to 30 crore, largely average around 15, 17. When we do NBFC and HFC type of books. So our idea is not to grow that book. Wherever we are, there may be 3, 4, 5% growth, not more than that. That is what even internal plans and even the board guidance is on those lines. That you be there, but don't try to grow this fast. So that is one part on the NBFC space. On the other book is what we call the business banking group, BBG group, where we try to give largely working capital or sometimes term loans also to smaller entities. That's technically SME space for us, where we normally do around 3 to 10 crore type of segment, and average will be around 4 to 5 crore for us. And till date, all the cases are 100% plus hard collateral, the loans we have given. So that segment we certainly intend to grow, because that segment comes with all other, you can say businesses also to us. Normally we will be preferred banker for them, or sometimes we will be sole banker for us. Not in all cases, but in most of the cases. So that is the segment what we intend to grow. We have grown well. I mean, we are around 500 crore plus right now, and our idea is to grow by around 40 to 50% that segment for next year. And that will be on a long-term basis, because the customer will be with us. I think that's the way we mentioned that growing together type of thing. So that is what is happening in case of BBG. But I'm just asking anything.
From a portfolio composition perspective, if you see micro banking as on March 23 was 66% for us, which has come down to 62%, 4% in terms of share. This is our expectation for financial year 25 as well. So maybe share of micro banking will come down by 3 to 5%, anywhere between 57 to 59% for financial year 25. And businesses, I mean, in terms of, let's say, MSME, going for I talked about micro lab, housing and these are the businesses which will increase in terms of size. Wholesale lending, which is at about 10% now, would remain at about 10-11% in terms of portfolio composition.
Fair enough. So a couple of more questions. One is on non-interest income. This quarter we have seen a very good jump in that. So what is on the sustainable basis? How can we see that non-interest income? Because the fourth quarter was excellent. So can you throw some color on that?
So non-interest income, obviously we had seen a good rate of collection this quarter. As Govinda had said, rate of collection obviously, let's say, may not get repeat, let's say, each quarter, something like that. But at the same time, if you see the PSLC income was much lower in quarter 4. It was only about 7 crore. For the full year, we have booked PSLC income of more than 100 crore. So on an overall basis, we think non-interest income would remain, let's say, largely at a similar level in terms of ROI metrics, or marginally lower depending on PSLC, demand-supply dynamics and the rate of collection level. But otherwise, overall other income should remain strong. I mean, other streams like, let's say, either the sale of third-party products and the transaction income, etc., should remain healthy and should increase as we are penetrating our liabilities account better.
Okay. Sir, last question from my side on credit cost. Are we seeing so obviously fourth quarter has been excellent for us in terms of collection efficiency, but overall on the MFI book, are there any pain points or pressure in general we are seeing, or how are we seeing FY25 in that case for us?
So generally, I think we have not seen any specific issue, at a larger level. But sometimes we do face, some local issues, some of the geography, some of the branches, and that keeps happening. And as a, MFI player, we have been handling those in past also. So there's nothing which is very specific to us. And as we mentioned earlier, also our trajectory for the collections, which was in the range of 97.6% or so, we expect that this will remain. Here or maybe a little better in FY25. We don't have any specific, issue in any of the places, but there might be sometimes, some of the unit level issue or some branch level issue do crop in, but not otherwise. Dhruv wants to add something on this, yeah.
So we don't have any specific area, but we have few districts in few states, like there are 2-3 districts in Jharkhand, there are 4-5 districts in UP, again 2-3 districts in Haryana. Otherwise, we don't have any specific geography where we are facing any such problem, which can affect our credit cost.
Okay, sir. Thanks a lot, and congratulations once again.
Sure. Thank you.
Thank you very much. The next question is from the line of Sarvesh Mutha from Antique Stock Broking. Please go ahead.
Good evening, sir. Congratulations on a great set of numbers.
Thank you.
My question would be on margins. So somewhere said that the steady state margin should be around somewhere between 9.2 to 9.3 and plus minus 10 basis points. Now we've exited at 9.9. So where do you see margins going forward, and how much of these margins are are led by the JLG repricing, and how much of that has been done?
So margins are, combination of multiple factors, as you are aware, and it was certainly much better in case of quarter 4. But the way we discussed in the last earning call also, if you look at the medium-term scenario, we mentioned the next 2 to 3 years horizon. I think margins, NIM will always be above 9%. That is what we have given guidance earlier also, and that remains, today also. Yeah, obviously, 9.9 will not be sustainable, but if you look at next year, maybe 9.4 or 9.35 type of margins are certainly there. And in medium term, it will be always be 9% plus. Medium when I say 2 to 3 years time. Any specific point you want to add?
No, from a repricing perspective, I just want to highlight right now, sitting as on March 24, there is about 20% book which is yet to be repriced fully. But at the same time, Govind sir had talked about the differential rate of interest which we plan to implement. So our thought process is that these two would offset each other incrementally for financial year 25, and hence from a microfinance yield perspective, we would remain where we are in quarter 4.
And this differential rate, how much of difference would that be?
So that is what I said. Roughly, our sense is that on account this repricing, we would have gained additional 20-25 basis points. And we think probably this will be, let's say, the decline in yield on account of this differential rate of interest, and broadly these two would offset each other in financial year 25.
No, so your current disbursements on MFI would be around 25%, and if you plan to do differential disbursement yield, so how much of a difference would that be in the yields?
So what we are planning, we are still assessing, but our sense is that we would be going, let's say, 1 to 2% lower than our guard rate for select better quality customers, better vintage customers, and so on.
Okay. And also on CD ratio, you had said that you plan to get it down further. So any broad range that you intend to get it down to?
So I think in last earning call also mentioned that on a year-on-year basis, we expect around 3.5% decline in the CD ratio for next 2 to 3 years time till we say 85% and below. And that trajectory for FY25 will continue.
Okay, sir. Okay, that would be all. Congratulations once again. Thank you.
Thank you very much.
Thank you very much. The next question is from the line of Vinay Nadkarni from Hathway Investment Private Limited. Please go ahead.
Yeah, just one, I have just two questions. One is the CD ratio last year was, you gave two numbers. One was for the year as a whole, 93 and then 84. What was the 93 number?
So 93 is our CD ratio, which is coming, let's say, from the face of the balance sheet. And 84% is because we have refinance borrowings on our balance sheet. When we reduce refinance borrowings, let's say from our loan, because those borrowings are taken to refinance the bond. And if we calculate our CD ratio, it is 84%.
Okay. And lastly, on the number of branches that you expect to open in FY25?
So this year we have a plans of opening around 150 odd branches. I mean, the number could be plus minus, by 10 based on, getting property in time and those type of things. But around 150 odd branches we expect this year. Out of that, general banking branches, around 60 odd will be general banking branches, and next 90 plus will be our micro banking branches across the country.
Okay. Thank you. Thanks a lot.
Yeah. Thank you.
That's all from me.
As there are no further questions, I will now like to hand the conference over to management for closing comments.
Just one more clarification, on data point with respect to the deposit tenor, which we had shared. So I meant basically, let's say deposits more than 3 year category is about 11%. 2 to 3 year is about 20%, less than 1 year is about 6%, and balance is largely in 1 to 2 year bucket.
And we also clarified on the ticket size of microfinance. It has gone up by 4% during last year, and the rest is
the rest of the growth is on account of new customers. Yeah.
Thank you very much for coming, and joining this call. And you have been always supporting us, and we look forward to continued support. I think you have seen the results. Last 2 points which were not discussed, I just want to highlight 2 points. One is that we have started dividend, paying dividend from this year. So we'll become a dividend paying company, and that is what is a small beginning from our side. And second, I want to re-emphasize on the floating provision. This year the board has directed us or guided us to make 2% floating provision on our JLG book. And the way we had told in past also, we intend to create a sizable floating provision so that any issue we are able to withstand. So and the way we have guided also, 30% growth in plus growth in the overall assets and overall advances, and 3 to 5% higher growth for deposits for this year. That is what we are aiming at. And other some of the ratios like ROA of 2% plus and ROE of 18% plus, and cost income in the range of 54 to 57%, and NIM being above 9% in the medium term, not for this year alone, but for the medium term. These are some of the guidance, from the management, from the board discussion. So again, thank you very much for joining this call, and look forward to your continued support. Thank you.
On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.